Hey, welcome back. Before we start today's lesson, let's take 30 seconds to recap. Last lesson covered 3 key things. First, ETF basics, 3 features. It's a basket of stocks, it tracks an index, and it trades like a stock. Second, the fee gap. A 1.2% fee difference over 30 years can cost you $272,000. So when you pick an ETF, the expense ratio is the key indicator. Third, 4 indicators and 3 steps. Pick by the index it tracks, the expense ratio, the AUM, and daily volume. Then 3 steps to buy: open the account, set up auto deposits, turn on dividend reinvestment. Okay, the theory you've got. But the next question. There are tons of broad market ETFs out there. Which one should you actually buy? Especially the 2 beginners argue about the most, VOO and SCHD. Both are popular ETFs, but the philosophies are completely different. Today we're settling this. Welcome to Lesson 6, VOO versus SCHD. Which one should you actually pick? Both are ETFs, with combined assets over $500 billion, 2 of America's most popular beginner picks. But here's what most beginners don't realize. The philosophies are completely different. One pursues maximum total return. The other prioritizes cash flow. Pick wrong, and over 20 years you could be off by hundreds of thousands of dollars. By the end of today, you'll know what VOO and SCHD each are, the 5-point comparison, which life stage favors which, and the 3 steps to make your final decision. Let me start with VOO. VOO's full name is Vanguard S&P 500 ETF, launched in 2010 by Vanguard. It tracks the S&P 500 index, the 500 largest U.S. companies, weighted by market capitalization. What does that mean? The bigger the company, the bigger the weight. Right now in VOO, the top 10 holdings, Apple, Microsoft, Nvidia, Amazon, Google, Meta, and a few others, make up about 35% of the entire fund. The expense ratio is just 0.03%. Among broad market ETFs in the world, this is one of the cheapest. AUM is over $500 billion, and daily trading volume is enormous. Distributions, paid quarterly, yield around 1.3%. That number is low, but the design isn't to give you cash, it's to keep your money compounding inside the fund. Over the past 10 years, VOO with dividends reinvested has returned about 12% annualized. In one sentence, VOO equals betting that America's top 500 companies will keep growing. Now let's look at SCHD. SCHD's full name is Schwab U.S. Dividend Equity ETF, launched in 2011 by Charles Schwab. It tracks the Dow Jones U.S. Dividend 100 Index, picks 100 large American companies based on dividend quality and consistency. What does that mean? Completely different selection logic from VOO. SCHD looks at how much a company pays out, not how big the company is. Right now the top sectors in SCHD are financials, healthcare, consumer staples, and energy. Tech weight is way lower than VOO. The expense ratio is 0.06%, slightly higher than VOO, but still very cheap. AUM is around $60 billion, with quarterly distributions 4 times a year. Yield is around 3.5%, almost 3 times VOO's. That high yield is SCHD's main attraction. But what's the cost? Companies that pay more out have less to keep growing. Over the past 10 years, SCHD with dividends reinvested has returned about 9% annualized. Lower than VOO, but the cash feel is strong, with quarterly checks landing. In one sentence, SCHD equals trading growth for cash flow. Now let's put VOO and SCHD side by side. 5 comparison points. First, return type. VOO pursues capital gains, total return maximized. SCHD pursues dividends, strong cash flow. Second, sector concentration. VOO leans heavy on tech and growth giants. SCHD spreads across financials, healthcare, and traditional industries. Third, dividend yield. VOO around 1.3%. SCHD around 3.5%. SCHD wins on yield. Fourth, expense ratio. VOO at 0.03%. SCHD at 0.06%. Both are very cheap, but VOO slightly wins. Fifth, long-run annualized return. VOO around 12%. SCHD around 9%. VOO wins on growth. Let's run the math. $100,000 principal, 20 years, both reinvested. VOO at 12% compounds to $960,000. SCHD at 9% compounds to $560,000. Gap, $400,000. Same money, same time. Just by picking different tools, you walk away with $400,000 more. But wait. Does this mean VOO always wins? Not at all. Let me show you a different angle. Imagine you're a retiree, 65 years old, with a $1 million portfolio. You don't want growth. You want monthly cash flow. Let's compare. VOO at 1.3% yield, 1 million times 1.3% equals $13,000 a year, about $1,000 a month. SCHD at 3.5% yield, 1 million times 3.5% equals $35,000 a year, about $3,000 a month. To a retiree, SCHD wins by $22,000 a year, without selling a single share. So the question isn't which ETF is better. The question is, at this stage of your life, do you need growth or cash flow? VOO is for accumulation. SCHD is for distribution. Now you see why it depends on your life stage. Let me give you 4 concrete scenarios. Stage 1, students or 20-somethings. You have decades ahead, no major expenses, full risk capacity. Allocation, 100% VOO, 0% SCHD, don't even buy SCHD yet. You don't need cash flow, you need maximum compounding. Stage 2, married, working, family forming. Mid-30s to late 40s, your career income is solid, you don't need monthly dividends, but you start wanting some stability. Allocation, 80% VOO, 20% SCHD, mostly growth, a little cash flow buffer. Stage 3, pre-retirement. 50 to 65. 5 to 10 years before retirement. You're shifting from accumulation to preservation. You want some assets paying you cash already. Allocation, 50% VOO, 50% SCHD, half and half. Stage 4, retirement. 65 plus. Income comes mainly from your portfolio. Cash flow is the priority. Allocation, 30% VOO, 70% SCHD. Most of your money generates dividends. The 30% VOO still gives you growth to fight inflation. Okay, you've seen the 4 life stages. So how do you actually decide your own allocation? 3 steps. Step 1, ask what you need. Question yourself honestly, what does your money need to do for you in the next 5 years? 2 options. Option A, I want it to grow as much as possible, I don't need monthly cash. Choose VOO. Option B, I need stable monthly income to support my lifestyle. Choose SCHD, or a mix. Step 2, calculate your time horizon. The shorter your horizon, the more you should lean toward SCHD. Why? Because VOO can drop 30 to 40% in a bad year. If you need that money soon, you can't afford to wait it out. The longer your horizon, the more you should lean toward VOO. The 12% historical compounding is the most efficient way to multiply your money. Step 3, rebalance once a year. Pick a fixed time, like every December, and check your VOO to SCHD ratio. If VOO ran up to 90% and SCHD dropped to 10%, sell some VOO and buy more SCHD to get back to target. This forces you to sell high and buy low. Ask need, calculate time, rebalance. 3 steps and your decision is locked in. Okay, that's a wrap on Lesson 6. Today you learned 6 key things. First, VOO is the broad market index ETF, total return focused, 12% historical annualized. Second, SCHD is the dividend ETF, cash flow focused, 9% historical annualized. Third, the 5-point side-by-side, return type, sector spread, yield, expense, long-run return. Fourth, 100,000 over 20 years, VOO grows to 960,000. SCHD grows to 560,000. Gap, 400,000. Fifth, for life-stage allocations from 100 to 3070, depends entirely on where you are in life. Sixth, 3 steps to decide, ask need, calculate time, rebalance. 3 small homework tasks for this week. First, write down your honest life stage, accumulation, transition, or retirement. Second, list out the monthly cash flow you actually need now, and the savings target you want to hit in 5 years. Compare which matters more. Third, take any ETF you currently hold, and run it through last lesson's 4 indicators. Once you finish those 3, you'll know exactly how much VOO and how much SCHD you should hold. Next lesson, we're tackling the world's biggest, cheapest, most diversified ETFs. VTI versus VOO versus QQQ, your gateway to US ETF investing. If today's lesson helped, please subscribe and hit the bell. See you next time.